JPMorgan CEO Jamie Dimon warned that the U.S. economy may fall into stagflation as a result of high deficits, policy pressure, and geopolitical uncertainty in an interview with Bloomberg. In appearances this week, Fed officials stressed the need for more hard data before reducing rates, downplaying the likelihood of a June or July rate cut. Our next guest says the Fed should lower policy this summer to preserve U.S. expansion. Here to explain, we've got Simona Mocuta, who is the State Street Global Advisor's chief economist. So take us into your thinking around why they should look at June or July and what that overall sets them up for the totality of cuts that you're anticipating this year.
Sure. I have to say there is very much a sense of deja vu. We made the same argument last summer, and the Fed, of course, was reluctant to follow through with the summer cuts, and then they came back in September with a larger move. I feel there's a decent chance we might be going into a similar scenario this year. And the reason I do think the Fed should cut despite tariffs is that the labor market and the economy as overall, I would argue, is at a much more delicate point to date than a year ago. The labor market is in balance, but labor demand continues to weaken. So I think the pressures from here on are towards more softness, not drastic deterioration, but there is more stuff that it's already baked into the pie, so to speak, with some of the DOGE moves that may not hit payrolls data until later in the fall, with some of the funding cuts that will have repercussions, but you may not yet see them in payrolls. So all eyes right now are on the inflation side of the Fed mandate. I'm a little bit more about the labor part, and that is the critical element in the economy, because the economy avoids recession if consumer spending remains strong, and that can only happen if the labor market remains strong. So it's an argument of managing both risks and perhaps accepting that whatever hit from tariffs we may have on inflation, which again, the picture is changing every week, and we don't know that, but the more steady trend of softening in the labor market is the one that should be paid more attention to.
And Simona, now we were just showing the Treasury market. Now we have, in particular, 30-year yields ticking well above 5% at this point. I'm curious what economic effect you see from that, and how sustained it has to be. In other words, do 30 years have to remain above 5% for it to have more of an effect, for example, on the housing market or on corporate borrowing costs?
I think we have a clear fiscal sustainability challenge that needs to be addressed. However, you probably also don't want it to be addressed all at once, because after the fiscal feast of the post-COVID period now, I don't want to go directly into famine, but you want to manage the fiscal trajectory. Sustain long-term interest rates at these levels or even higher would really dampen the economy's ability to grow. So I am hoping that we, from here on, pursue a more growth-oriented agenda. There is a lot still that can be done on deregulation and so forth. But if you come back to what does this mean for the Fed itself, you can argue, well, the market is doing a little bit of the lifting for the Fed, right? Higher long-term yields perhaps does allow the Fed to actually offer a little bit of relief. And again, we are talking from a place where policy is still restrictive. So I think, in fact, for the Fed, it creates a little bit of an opening. The challenge for the Fed is, the news flow on tariffs and the uncertainty thereof.
I guess it's interesting because policy restrictive, as you were mentioning, but as we were coming into the year, and still much of the narrative has been around some of the resiliency to this point without a larger trend of major cracks showing up that would push the Fed to more aggressively institute cuts at this point. So what is the risk of them cutting too soon with the absence or without the presence of that longer trend that they're looking for?
So I'm glad you showed briefly that chart that showed the Fed funds rate and nominal GDP growth. And those two at this moment are pretty much on top of each other. In expansion periods, Fed funds as the ultimate low risk, interest rate metric should be substantially below GDP growth, nominal GDP growth. And you can think of it, it's not a complicated modeling issue, but just think of it, the cost of capital versus a proxy for return of capital. Cost of capital, Fed funds, return on capital, nominal GDP growth. At this point, there is no headroom there. There is no incentive to invest at this rate. So there is a lot of debate among economists about what is the neutral rate. This chart is independent of any arguments around neutral rate. It's telling you in the context of today's economy, interest rates, the Fed policy setting is tight, and typically this level of tightness preceded recessions. If you look going back to the last few recessions, this has always been the case. So this is why I opened by saying this is a delicate moment. I do not want to dismiss the fact that the Fed, of course, needs to take into account inflation, but inflation, I would prefer a little bit higher than target inflation without a recession than exactly a target inflation with recession, because I also have to believe a recession worsens the fiscal picture in and of itself, right? The counter-cyclical support measures that have to be pushed through. So it is complicated. At the end of the day, I think every economist might develop their own advice for the Fed here. Mine is that you should not be afraid to cut. We are not talking here, hundreds of basis points, but, calibrate policy rates lower. We expect 75 basis points worth of cuts this year, whether they happen in small increments or a 50, at some point, I think it's less relevant.
Gotcha. The risks skewing in that direction. Simona, thank you so much. Appreciate it.
My pleasure.